Hey guys, Adam Rose, Vice President and Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. Today is another episode of the Mortgage Guy podcast, and the topic is appraisals. And sorry, I'm sitting here the last couple podcasts, long sleeves, man. It is freezing cold outside and in this podcast room. So bear with me here. I'm not much swag right now. So anyways, there's a bunch of lawsuits flying around about appraisals, some large companies moving orders directly to certain appraisers. We're not really going to dive into the lawsuits or anything like that specifically, but we're going to talk a little bit about appraisal practices and some of the things that they're kind of sticking points with some people, I should say, or a point of concern, you could say, for realtors, buyers, sellers, stuff like that pop up during the lending process. But, before we really dive into that, I want you to have an understanding of where some appraisers are coming from. Not some, all should be coming from due to guidelines and selling guides for Fannie and what the GSEs expect. And when you're doing a VA, USDA, we're not going to dive into like specific criteria per se, per appraisal, but, why they do what they do, why they have to do certain things that we can't really get around, which doesn't always make sense to the typical consumer, right? Or even people that are professionals in the industry. So, we, here at WMC, we pride ourselves in trying to be flexible when we run into repair issues and what makes sense and what doesn't. But sometimes you're dealing with certain people on the other side that you can't quite get around certain items. So let's talk about that. So when underwriting risk, the appraisal is typically the first thing that is going to be reviewed. Also by the secondary market, so like the GSEs, which are in charge or delivering VA and USDA files and FHA files as secondary, and Fannie and Freddie and stuff like that. If a loan goes south, that's usually the first thing that gets hit. Okay, so let's do a quick example. Let's say we close a deal, all right, and then there's nothing wrong with the deal, right? Defaults happen. It could be a great credit score, good job time, good income, good debt ratio, everything's there. But something happens in their life. A divorce happens. Job loss happens. A lot of things can happen in people's lives that cause a default, not because they were just a risky borrower in general, but to good borrowers as well, of course, that seem to be safe. But let's say this loan goes into default, okay? And I don't know, let's say it's a Fannie loan, okay? So after it goes through all this stuff, it's an early payment default or what have you. The investor is going to be foreclosing on this property. Fannie wants to kick this back, right? They want to get their money back, and this is the way it goes sometimes. So they're going to try to push it back on the lender, saying, hey, you're going to rebuy this loan. The first thing they're going to be looking at is the appraisal piece. That's always the first thing, because when you meet all their guidelines from between income, credit, and debt ratio and assets, and you've done your job and you've done it well, they don't have a whole lot to look at or go off of other than possibly the collateral that may not have been underwritten properly or may not have been appraised properly. So they'll deem those appraisals faulty. And the thing is, why this is so important is if a loan comes flying back, it causes losses for the lender, right? And if the appraisal truly is the issue and the reason, those losses can be claimed and pushed back against the appraiser on their E&O insurance. So you do that a couple of times as an appraiser, you learn pretty quick. But if you consistently do things that you're not supposed to, you can also be put on a blacklist for lenders, right? Saying that this appraiser cannot be approved through us, we've had too many issues, so it can have an impact on their job as well, right? Their livelihood. So, that's just a little background on why sometimes appraisers do what they do, and why some lenders push back on some requirements as well to make sure we're covering our own butts. Because, it like I said, it doesn't always make sense to the consumer. It doesn't always make sense to the typical buyer, to the typical agent. Some people have a good understanding of it, and some of them don't. And that's, it's just life. So let's talk about some of the common issues that are considered unacceptable appraisal practices. Number one. So this is big because the valuation is the most important piece here, right? So when this value gets put in, something called SSRs. There's a risk score associated with it. So we might email you out and just say, hey, value hit, we're good, no repairs needed, everything looks fine. Maybe we haven't pulled those SSRs yet. So there's some risk factors involved in that, where Fannie Mae or Freddie, they have a bunch of data in the market on comps, right? So they kind of have a pretty good idea of where this value should hit just based off the data that they already have without sending a person out there. So depending on what we get back from the appraisal, Fannie Mae will assess it with a score, in regards to risk. Is it a high risk appraisal? Was it a little outside the realm of what they thought it would be? So the number one thing here, failure to use comparable sales that are the most locationally and physically similar to the subject property. Why I talk about this is, when a listing agent lists a home, I am not privy to the conversation that listing agent has with that seller. I don't know if the listing agent has told him, listen, I think your house is worth 200, but if you really, really want to list it at 220, we can. I can't guarantee that value is going to hit. I don't know if that conversation is happening. I don't know if they're overpromising and saying, I really think we can get $220,000 for your house. I guarantee it. There's no reason for it to not to hit. So it puts more pressure on that listing agent if the appraisal comes in short, right? So since we're not privy to this information, appraisal value comes in, and let's say it's a 220 list price or contract price. The value comes in at 200,000. Well, we have some options, right? We can go back and try to get a reconsideration of value, and there's a lot of steps on doing that. But the number one is asking the listing agent and the buyer's agent to help to try to provide us some comparable sales that they believe support the value or the sales contract at that 220. Well, a lot of times what we see are comps. They are comps, but they're a little bit farther out, right? 5 miles, 6 miles, 7 miles, maybe a little different in style. But it is part of the Fannie Mae selling guide and all selling guides when it comes to the GSEs or Fannie that they have to use the most common in regards to the style, the most similar to that property, and location is key. If there are two comps that sold in that neighborhood that are extremely similar to the subject, they've got to put them in the report, and those are going to be heavily used, right? Because of the subject, the neighborhood, where they're at, all that stuff. All the same factors in regards to your neighborhood are going to be put in place as the homes that sold down the street. So that's a challenge trying to get a higher value. It just is. We've won a couple of battles with that, but it's few and far between. I can tell you that if appraisal comes in short, typically speaking, is not because an appraiser is being short-sighted or they're a jerk or they don't care about the transaction. They do. They really do. It has an impact on their job as well. I can tell you they've done a lot of research when they come up with that value. All right. So I know we like to blame appraisers like they're these evil people that control this whole industry. They're not. All right. We have a ton of amazing appraisers in our market, and they do their job pretty well. Sometimes they can't see the forest through the trees. That does happen, and we try to fight back on some of the little piddly things. But so just a heads up there, right? That's the number one on their selling guide. So if a loan comes flying back at us because of a default, what have you, the appraiser is going to get notified, and they're going to get some pushback as well. So that's why a lot of times you may not get a reconsideration of values, because they are trying to use the best comps that are available, not the best comps to get the highest price, right? There's a difference. Anyways, misrepresentation. This is number 2. Misrepresentation of physical characteristics of the subject, improvements, or comparable sales as well. So, I don't know. Let me just give you an example. Stating that, a home that was remodeled in 1995 that has basic countertops or, like white Formica countertops and basic everything. Comparing that, saying it's considered remodeled versus like a home that was remodeled in, 20 years later, 2015, with granite countertops, higher quality cabinets, better flooring, stuff like that, is not the same, right? Appraisers, and where this comes in at, appraisers really do try to meet your contract price. That's their target. If there's more value there, they're definitely going to give it to you, but that's what they're shooting for. So when comps are pulled that are classified as remodeled, the year plays a role. It really does. If it was remodeled, we're in 2025. If it was remodeled in 2005, and that's what everybody is boasting, it might be a very beautiful home. But if you cannot use a comp that was just remodeled 3 years ago, the quality material is different. Everything is totally different. So we can't put those on the same grade. So that's where condition of property comes into play. In the quality, right? So that's something that isn't quite the same when you're doing comps. Like if you're an agent, you're pulling comps. That will play a role on the adjustments. Okay. All right. And then number 3 is failure to comment on negative factors with respect to the subject neighborhood, property, or proximity of the subject to adverse influences. So you got a gas station across the street. Well, that's a problem. Right, that's a marketability issue. That's what it really boils down to is marketability. If you're in a neighborhood that has a highway, in the backyard practically, and the only thing that's separating is one of those noise canceling. It's not noise canceling, but one of those walls, right? One of those highway walls to help reduce noise. That has an impact on your value as well. Are there schools in the area? What do the rest of the neighborhoods look like that surround it? Access to certain amenities. Is it close to commercial buildings? There's just a lot of stuff going on there that can have an impact, and they have to make comments on that because it has an impact on the marketability for that property, which does impact the value. Okay, so you could have a home that's 1 block away from a business district and take that exact same home and put it 2 miles away or on the other side of town, just in a different neighborhood. You are going to get a different value, even though it's the exact same home. Because the neighborhood, the marketability of that home is different. It will have an effect on value. They are not the same, and that's something we always have to remember. But that's why we run into appraisal problems every now and again, and that's probably the number one sticking point when it comes to the realtors, of course, right? Because we all want the deal to go through, but trying to improve value or trying to get away from not repairing a certain item because some appraisers are a little bit more nitpicky when it comes to repairs than others. This is why, though. This is why specifically. It can have an impact on their licensing. It can impact on their bottom line. And it has an impact on the lender as well. So although some of this stuff seems petty, I could use that word, I guess. It seems a little petty, some of the small repairs. And we disagree with a lot of them as well. We understand why is being asked for. There's a lot more to it than just getting the transaction done. There's a lot more risk involved down the line if that borrower's been there for 6 months, 12 months, 18 months. I mean, we're seeing deals 5 years old that there's nothing wrong with them, but everybody was busy between 2020 and 2021, and Fannie and Freddie didn't get an opportunity to really review a lot of those appraisals. And sometimes you get some pushback from old ones that are actually performing, and there's nothing wrong with them. But this is why the appraisals are heavily scrutinized. So I just wanted to bring that to light, have that conversation, open the dialogue a little bit, have some comments by all means. Maybe I'll have some appraisers comment. We'll see. But I just wanted to give a little background on why things are asked for and why we need to do certain things. So I know I ramble a little bit. Sorry. Anyways, guys, make sure you are subscribing to our YouTube channel. Check us out on Apple Podcasts and Spotify. And I hope that information was helpful. And we will catch you all next week in a new episode.